Um, I know there are a few more who will be joining us, but we will get started in the interest of time. I want to welcome all of you for attending the Succession Tsunami. It's the CPA's role in the team in creation of a successful exit plan. Ruby will be taking probably the majority of the time in how you can help your clients prepare for an exit plan. And then I'm going to take the last third and talk about mergers and acquisitions in the accounting profession. So may I start off with some housekeeping rules? First of all, this is being recorded. The recording and the slides will come out in the next several days. You'll also get a PD certificate for today's session. If you want to ask questions, I really encourage you to put them in the chat box, and Shelby will either ask them at the appropriate time or we'll save them to the end. But please don't hesitate to enter your questions into the chat line. It's my pleasure to introduce Ruby Lahidiani. Ruby is the VP here at Wealth Stewards, and she works solely with accounting firms in the integration of wealth management. And the things about Ruby that are exciting is that she's passionate about providing businesses and owners with excellent financial advice at critical stages in their business cycle. As a multi-credited financials professional with a CPA, a CKA, and also a former CFP, CIM, and FCSI with broad experience including public accounting, business operations, controller, entrepreneur, owner, practice management, financial planning, portfolio management, business development, and investment banking. She really has the expertise to help owners make sound decisions at critical times that are often complex. Ruby has an excellent reputation of integrity, results, independent thinking, and mutual respect. Ruby has so many other areas of interest. In her spare time, she enjoys travel, water sports, yoga, golf, trail running, biking, hiking, and helping small organizations that have throughout time that have changed. But currently, the focus is on charities that provide help ideally, this is women to fight poverty, human trafficking, and watershed stewardship. We are thrilled that Ruby is one of our team members, and we look forward to what she has to share today. Thank you, Ruby.
Well, thank you so much, Peggy. I think for this seminar, probably the most important thing I want to share about myself is I've been there. I have gone through my own succession tsunami and know how important planning ahead is, and then planning for the unexpected is very important too. So just to proceed then, we're gonna talk about the agenda. Is that this is how my discussion is just going to be about why this is an important topic now. And then we're going to talk about 10 very important questions. And I'm going to say to ask yourself in your own practice, but then also to ask your clients who are business owners. And then we're going to talk about as a CPA, the CPA's role in the succession tsunami and exit planning and succession planning with your clients, and also the incredible value of a team approach. So why is this so important? So a personal story is that it happened to me, and I got disrupted my own practice. And, we've all heard the 5 Ds in how people end up exiting. We're disrupted. There's disagreements. There is often a reason to exit is there's been a divorce. And disability. Nobody expects to get disabled, but it happens. Death. Definitely, you're going to exit your business on death. And in my own life, I never expected to retire as early as I did, or to sell my practice as early as I did. And I had actually been at a conference called Disrupted and talking about these very issues. And well, within 4 months, I was so disrupted in my own practice that when I received an unsolicited offer to purchase my practice, my husband basically begged me to, and I really felt it was the right thing for me, my husband, my family, my clients, the suppliers that I deal with. And so I did exit my practice. And then another funny little story is that it's called Tsunami because riding a wave, it's really important, as I learned when I learned to surf in January at a mature age, so shall we say, that it's all wonderful to ride a wave, but you better know how to exit. And me personally, getting up on the surfboard, I think nobody expected me to. And as a result, my instructor didn't tell me how to exit the wave. And that was very painful. And I'd like to prevent other people from having that experience too. So there will be a decade of small business transitions ahead. And why this is, why we have to talk about this is I'm just going to share some of the statistics with you. That 76% of business owners, and consider your own practice, and I think the statistics for CPAs are even worse, is that 76% plan on exiting within the next decade. And you know, as CPAs, you need time for the purification, for the corporation, for all the planning that you need, you're critical in preparing for these exits. And, you know, that means over $2 trillion worth of businesses could change hands in the next period of time. And, you know, when you think about that dollar amount, that's huge. That's, you know, as big as some of the biggest companies in the market, and also exceeds many countries' GDP. And the sad thing is only 1 in 10 business owners are actually prepared. Less than that. So only 9% have a formal written business succession plan in place. And I was actually one of those people, and it still caught me off guard because, as I said in the 5 Ds, being disrupted, I plan for a lot of things, but I never plan for actually what happened in my own case. 39% of owners have changed their business exit date because of COVID-19. You know, it's behind us, thankfully, but, you know, we've had a little spike this fall with COVID coming back. 17% of people have accelerated their timeline. 22% sadly have delayed it for a lot of, you know, reasons with what's gone on. Also, most owners, so 75%, will leave their business because of retirement. They want to retire. We're all getting older demographically, baby boomers. The last of the baby boomers will be turning 60 in 2025 rather. And so because of this, they're thinking about retirement. Those are the same people that, you know, the last of the baby boomers who grew up with this attitude of Freedom 55. Many of them want to leave just because of the stress of being an owner, regulation, taxes, growing compliance requirements. They're just tired. Another 21% want to step back and go, you know what? It's a huge responsibility doing this, and I want to have a break. So finding a suitable buyer is very critical, and it's usually the most common obstacle when business owners and when professionals want to sell their practice. And it is the most common one because historically it is the most challenging, followed closely by the valuation. So, You know, am I getting enough? Is this going to be enough? And that's so important role that CPAs can play in conjunction with financial advisors to say, how much is enough? Do I have the correct valuation on my business to begin with? A lot of things are changing constantly with AI, with technology. Look at how much the world changed during COVID. And also the whole issue of being reliant on the owner for the day-to-day operations. So what are you selling if you want to retire or leave, or one of these 5Ds have affected you, if really the business is just you, right? And that is very critical. Just under half of owners, so 49%, are going to sell their business to an unrelated party. And we're seeing a huge increase in that. We're very familiar with at Wealth Stewards with private equity, that there has been an incredible increase in the use of private equity by institutional money managers. We've heard it increasing over the years in Canada Pension Plan, Teachers Pension Plan. It's becoming much more democratized. You can access it. Many people are now able to access it through their financial advisors. Not very many yet, but more and more. Less than historically, but 24% are going to want to sell or pass on their business or exit their business to family members. But that's actually reducing because there's so much more choice now for people, and people want to do their own thing. There's much more of an individual approach versus a collective family business approach. And this I'm expecting to increase. I'd like to see some of the stats since the employee ownership rules and transition rules to employees are changing. But about almost a quarter, 23%, are going to sell to their employees. So I want to challenge all of you. The best thing that ever happened to me when I first started my practice was I was challenged by a partner at KPMG to be the change I wanted to see in my practice. And then after that, not only be the change you want to see, but also to practice what you preach and to lead by example and have some integrity and legitimacy when I spoke to my clients. That was always very important to me. And I believe it's one of the reasons for my success. And I do want to do the same thing with you. So I do want to challenge you to be the change you want to see with your clients, to lead by example, and to really practice what you're sharing with them. So make sure your own practices are can operate without you, that you are prepared, that you have a plan, that you know what your financial finish line is. And not just on that exiting, but just making sure that your clients have the right disability insurance should something happen to them and some of their key employees, for example, and their own death and retirement. If they don't know, it's really important. You've got an important role to play. Have you thought about how to maximize the value of your own practice? I know that we often talk to our clients about it, and we talk to them about ideas, their SWOT analysis, but the whole issue now with recurring revenue and how sustainable is cash flow, you're hearing that a lot in industry. Buyers will pay more for that. And helping your clients get good advice is also going to keep them with your firm, keep them with you, really solidify that relationship that you have with your clients. And just really understanding that your client's success in how they exit and having a good exit from their business, you may think that you're going to lose them perhaps as a client, but it actually really ensures loyalty, and you are creating raving fans, because it's not happening that as much as you would think out there in the industry, and it would be a huge differentiator for you. So I want to go into the 10 questions that every CPA should ask all their business owners, okay? And the number one question, the number one is, how do you see your involvement in your business changing or evolving in the future? One of the biggest impediments, and I remember one of my biggest clients, huge business, even, the founder of the business was in the hospital, basically dying. And that next generation just couldn't see what was happening right before them. They couldn't see that evolution and the exit, even at this really late stage. So you've got to talk to them, and you've actually got to paint a picture and help them see that their involvement in the business is naturally going to change, and there will naturally be a day. They don't want to think about it. We never want to think about exiting, especially those of us who are very passionate about what they do, and most business entrepreneurs are. They need to see, they need your help in seeing how their role is going to change in the future, that it's not necessarily something to be afraid of, but you can add so much value just starting the discussion. Number two, ask them. And this will really help them solidify it and see it a little bit more. Ask them, what is your next adventure after you leave your business? So that gives them permission to actually go, okay, it's not going to be all doom and gloom. This isn't going to be something for me to avoid, because there's not going to be anything after I leave my business or my practice. That they have to really see it as an adventure. And there's so many different things. I was reading in today's Globe and Mail or yesterday's Globe and Mail, there was this really good example of a professional business owner saying he doesn't think of it as retirement, but inspirement. And I thought, wow, that's a wonderful word to hear. And I've heard, instead of retired, as you know, I've told my husband today, we have snow where I am, and make sure that you change our winter tires. We have to go from being this to this because of what happens around us. But what will be your next adventure? Is it going to be, you have to get them thinking about not going into the office today, and what dreams would they have? Would they like to go south and golf, 3 or 4 months out of the year? Or are they the type of people that, man, they want to go to, help other people. They want to actually be involved in their community in some way, shape, or form. Do they want to lead other business friends of theirs and do something philanthropic, perhaps, in a developing country or something? Talk about these incredible opportunities for adventure. Number 3, you have to talk to them about obstacles. So what are some potential obstacles that could derail their business or even their personal goals in the coming years? So again, talk to them about those 5 Ds. Nobody wants to think about being disrupted, being disabled, getting a divorce, having disagreements, or, God forbid, but death. But they're going to happen. It will happen. And then also even looking at the business itself, doing a SWOT analysis of their business. You may have helped them do this in the past. You may have done it for your own practice in the past. It's time for you to do, what are my strengths, weaknesses, opportunities? What are some threats out there? Many CPAs I've talked to lately talk about technology, and there's so much discussion about how is AI going to change my business. So also have them look at key people within their organization and their business, and you can do this in your own practice too. What if one of those 5 Ds happened to some of their key people? Okay. Number 4, what role does your business, Mr. Client, play in helping you achieve your financial freedom. Many CPAs don't know, it's not something you talk about on a regular basis. You may get some T-slips and RSP deductions, but are they going to be okay with something like a 5D happening? Is exiting the business well really what they need for their own financial freedom? Right? And you need to ask them those questions. Don't assume that you know what the answer is. You need to ask them. Do they know what their financial finish line is? Do they really understand the difference between like needs and wants in their own post-business owning career? They may spend, 30,000 a month, but in retirement, that's not a need. That may be a want, and that's going to make a very different financial finish line for them and probably make them much more at risk or dependent on a very successful exit. So number 5, what is your plan for the ownership interest in your business? Do you plan to pass on the ownership along or arrange for a sale one day? I'm not sure why the slide isn't moving, but that's okay. So number 5, what is your plan for the ownership interest in your business? Okay, there's lots of options. We will all exit one day, and as voluntarily or not, but as Rockefeller is often quoted as saying, you can't take it with you. You can't take your business to the hospital or to the cemetery. There are many reasons why you really have to plan. What is it going to be like when you actually pass on that business to a private equity firm, or your son or your daughter or another family member? But what is that actually going to look like? Get them in that mindset of looking forward, thinking about it. How are you going to do it? Because that will be something that will be very valuable in this planning process going forward. So the 6th most important question that you need to ask your clients are, or think about is for your own practice is, what method or methods have they used to assess the value of their businesses? So many business owners talk to each other all the time, or they have an idea because they may have bought or sold businesses in the past. How do they view the value of their own business? Are they looking at it on an asset basis? Are they looking at it on a sustainable cash flow basis, a profit basis? Are they looking at the value of their intellectual property? Are they looking at, client lists and those types of things? And how confident are they in that process? So if they have some very key employees, legislation that changed recently about non-compete agreements will change a lot of this for many people, and they may not have thought about it. And it would be wonderful if you could bring this up and have some discussions with your clients. It's tough to do that, but it's very, very necessary. So number 7, given your buyer or successor, if it's a family practice that they want to move on, given your buyer's plans, have you thought about who the best leader of your business might be? You might have a very different perspective than the successor or the business owner does. A wonderful example that's been in the media a lot lately is Rogers Communication. There's another wonderful book called Willing Wisdom and Every Family's Business that goes into, with family businesses, why it would be very useful to be detached from leadership versus ownership. Warren Buffett's a great example of this. One of his children is not taking over as CEO after him. He is very objective and emotionally detached from making that decision and is choosing the best person for a job. Just a little bit of interest here. It's a Canadian CPA who is Warren Buffett's successor. So that's always good news. But leadership and ownership and successors and founders are very different people. So remind your clients or ask them those questions and think about it yourself. Who would be the right leader for the business in the future? Number 8, and this was really in my own practice a challenge in hindsight. What do you think will happen to your customers, your clients, your vendors, your employees, and your competitors if something happens to you? If you face one of these 5 Ds that puts you in an exit position, ask your clients, ask yourself, what's going to happen? This is very important because many of the other questions we've dealt with, for instance, with leadership, who is the best leader to say, deal with a change in your organization? And will competitors look at it differently? I had a wonderful example when I did some mergers and acquisitions after I sold my practice about a client who was exiting, and the M&A firm, they got the biggest bid was a competitor, and the owners were no, we can't do this. We can't do this to our customers because XYZ, this competitor will have too much of the market and it will increase the cost to our customers. And we love our customers. We have this wealth because of our customers. I won't do this to our employees because, they have a reputation of being with their employees this way. So it was worth saying no to the best offer to exit this business because of what they thought would happen. So it's really important to have these conversations ahead of time, because when you sell to a competitor versus at the end of the day, this company ended up being sold to a publicly traded company, but the way you prepare for those different outcomes is going to be very different. Okay, so competitor has all the leadership in place, a public company likely won't. And so there's important aspects that how it affects your clients and even your own practice when you're selling to another local or somebody internally in an exit, in another smaller local firm or a medium-sized firm versus a great big national firm. Number 9, and hopefully I still have you because these are all very important questions, but which planning suggestions have you, Mr. Business Owner, Mr. Client, have other business advisors given you to prepare for the future ownership of your business? Get them talking about it. You may not know, or they may not have shared it with you, but maybe some of their friends who own businesses, they've gone out for dinner or they're socializing and they've said, boy, this was the worst thing that ever happened to me, or this worked really well for me. Get them talking. Their financial advisor, their banker, their lawyer may have had suggestions, and this is all going to impact you. Things like making sure that you do estate freezes and opcos and holdcos and family trusts. These are things that will take time, that are really important. You may want to understand where a lot of their perspective is coming from by asking this question: what planning suggestions have other people who give you advice in your life, maybe a spouse, maybe a cousin, maybe you just don't know, but ask these important questions. And finally, number 10, what do you see as your greatest challenge when you think about planning for the future? So I had one of my former biggest clients say this to me, TIME. And they said, I don't even have time to think or plan about this because I have no time. Time is my biggest asset. That was their biggest challenge. They were over capacity so that they didn't have the time to plan. And you probably heard that old saying is that if you don't plan, you're planning to fail. So these are important questions. This is a very, very important question. You may uncover some things. I had a M&A client that said, I've got a lot of skeletons in the closet with my business, and that's my biggest challenge. Or another client may say, you know, it's just not coming into the office every day. I can't see myself doing that because my office is everything to me. It's my social network. It defines me as a person, and I that's my biggest challenge. Or it is, if I'm not there, the two kids that are going to take over the business will fight tooth and nail, and I'm worried something really bad will happen to the family. Whatever their biggest challenges, their greatest challenge, start talking to them about it now, because you are experts and you may come up with solutions. You may, you know, the more we think about these things and collaborate, and we're going to talk about doing that with teams, the more that your clients will have a better exit and a better succession than if you forgot to ask this. So it's really important that you ask them, what do you see as your biggest challenge? And ask yourself too, okay? So CPAs, what is your role in this massive succession tsunami that's about to happen? So, you know, there's a saying, you may not have caused it, you can't cure, you know, one of those 5 Ds that happen, but you can communicate. And it can't be understated, the power of communication. For instance, look at what social media has done, you know, to politics, to all kinds of things as a method of communication. So your clients look at you as an expert in all things financial, and you're probably their most trusted advisor. They trust you with the numbers, with the finances. You're it. So you need to inform and educate them. And if you don't know, then you need to collaborate. You maybe need to facilitate having a coach. And at the last presentation that I did with the succession planning tsunami, there was a coach in this training session and talking about so many of the issues that they need to be coached on, whether it's partner dynamics, family dynamics, customer dynamics, even their own personal coaching that they need to go through for looking at the future. And that's something that you could perhaps facilitate. You may have somebody on staff, you may have networks. If not, like, please reach out to us. We definitely do. And also in facilitating that whole planning process, you can also provide services. You may have CBAs on staff. You may also go, okay, we need to look at purifying the corporation. We may need to look at the new rules about the lifetime capital gains exemption. Oh, now there's, you know, some new rules about transferring ownership to employees and different family rules coming into effect. You may have work with or have enough experience in mergers and acquisitions that you may want to start getting that process together and start thinking about, what's your pitch deck going to look like? What are they going to need from us for that pitch deck? Because you're going to play a critical role. You know, the whole use of opcos and holdcos and trusts, etc., alter ego trust. There's so many different Henson trusts, different things that you're going to have to work very closely with their legal advisors, making sure their wills and powers of attorney are up to date. So I just wanted to finish my part of this presentation and hand it over to Peggy. And Peggy and her husband, I have known for many years. And after exiting my own business, I must say I was absolutely delighted, flattered, and have gotten to know Peggy a lot better than just professionally in the past. And she is extremely competent and passionate about this also. So I want to hand over this part of the presentation to Peggy as she's going to talk to you about getting your practice ready for sale. And she has experience with that. That was one of the hats that Peggy played for a while, is helping CPAs sell their practices. So thank you.
Thank you, Ruby. That was excellent. And one of the other points I really should make at this point, as you get to work along with these clients who've got their practices or their businesses ready for sale, those owners have known how to run that business. That's been their life. And all of a sudden, the business is now for sale and they come into all this money. They don't know what to do with the money. They don't know the best way to get the money out. And that's really the important part as the accountant. And if you're working with us, that we can help the client. And I can tell you without a doubt, and there's some on this call, that the biggest clients that we have got this year are those clients who have been referred to us by accountants because of the sale of their companies. And we work hand in glove with the accountant to help that client. And some of them have been quite young, and there've been some of them that have been quite old that have exited their companies. But it is the same scenario. They don't know what to do with the money. And I can tell you, as long as you're working along with Wealth Stewards and participate, what has become very clear in some cases is that you're going to make more in helping them with the financial end of their business than you did with the accounting. I have to throw that out there. So thank you, Ruby. And Ruby is absolutely correct. There was a time in my career that I worked with Joel Sinkin and Terry Putney in Transition Advisors. They were two gentlemen out of the United States. They absolutely were well known. They were advisors to the AICPA on mergers and acquisitions of an accounting firm. I had the privilege of representing them in Canada, and I had the benefit of working with them and drawing on their wisdom and experience in the sale and transition of accounting practices. So how do I know if my firm is ready for sale? There are three options: internal, external, and merging. Most firms have a substantial number of clients, both business and personal, whose primary contact with the firm is an annual meeting with the principal. When a practitioner says they have 5 years from retiring or devoting less time to their practice, it sounds like an eternity. But in reality, in many cases, it's only 5 visits with that substantial portion of your client base. Think about it. 2 years really means 2 visits with a client, especially if it's a majority as T1 clients. Whatever you paid for your practice or interest in your firm, it will normally be based in a large part on the acquiring firm's expectation of its ability to retain your clients. And it takes time for your successor and clients to be acclimated to each other to transition the trust and the loyalty of your clients to them. This applies to both internal and external plans. And the longer and more actively you participate in the transfer of trust, and more likely the transition will be successful. This expectation of high retention should elevate the value of your firm, and the actual successful transition of client relationships will be more satisfying with you. So as I mentioned, the 3 options: internal, external, and merge. And we're going to explore these briefly. It's been my experience, and I've heard it from many small practitioners, sole practitioners, dual practitioners, saying at the end of tax season, that is the last time I'm going through a tax season. How many of you have experienced that, or at least thought that? And what happens is that the model that you consider in selling depends on that exact statement. And preparing your practice for sale is not something that happens overnight. The process needs to start 6 to 12 months, even up to 2 years before you plan to sell, to give yourself time to organize the practice, find a suitable buyer, and negotiate a fair price. The internal sale. The internal sale. Do you have a shareholders agreement? That should really outline the conditions for a sale of the retirement or the sale of the practice for the person retiring. If you don't have one, I strongly suggest that you get one put in place, because that will be beneficial to you at the time of retirement if you're doing an internal. How do you value your practice? And firms need to know whether their clients are partner loyal or brand loyal. Clients who are more loyal to a partner than to the firm take a lot longer to transition to other professionals in the firm. It usually takes a minimum of 2 years to transition a client from one partner to another, even within a firm. And usually the price to sell internally is slightly lower than selling to an external buyer. Inside valuations traditionally use a lower multiple of billings than external deals. Most retiring partners don't expect their partners who help build the business to pay the same price as a stranger. Plus, the terms of inside transfers often are fixed by the price at the date of retirement, and the firm is obligated to acquire the ownership interest, both of which justify the lower multiple. And many inside transfers are based on multiples times billings times ownership interest. The external sale. An increasing number of smaller regional firms are discovering, or will discover in the near future, that they don't have the cash flow or the young talent to execute an internal succession plan. The firms then have little choice but to seek to exit via a merger or an acquisition. The trend is producing a larger supply of smaller regional firms that are shifting the power to the marketplace to the buyers and creating a downward pressure on firm valuation. We know that the mid-market firms such as Grant Thornton, MNP, are actively seeking out sole practitioners in small firms. And likewise, the bigger firms are looking to purchase mid-size accounting firms or regional type firms. And despite all the turmoil, a firm's size and location continue to be the factors in determining its appeal and value to potential buyers. For instance, small firms in a densely populated area such as Toronto or Montreal are operating in a seller's market. There's a plethora of firms with the capacity to buy smaller competitors, giving selling firms a number of options when seeking a buyer or suitor. The market also favors the selling firm because many mid-sized firms can absorb those small firms with little to no incremental increase in overhead, especially if the selling firm isn't locked into long-term expensive leases. This makes an acquisition a cost-effective means of growth. Buying firms, thus, are willing to pay a slightly higher price of acquiring smaller operations because it's still cheaper to acquire them than growing one client at a time or adding a niche to create cross-selling opportunities. The limited supply of potential buyers means that it's difficult for a selling firm to find a suitor in some areas. Accounting firms don't feel pressure to acquire. In contrast, if you're in a smaller area, for instance, north of London, some of those small communities, it's a limited supply of buyers, and that makes it difficult for selling a firm. Buyers don't feel the pressure to acquire a retiring competitor's clients because there's really no place else for the clients to go. So if one of the accounting firms closes up, it's quite likely that they'll just go to the other accounting firm in that area. But one thing we know, that there's going to be a lot of M&A activity over the next few years, as Ruby mentioned, as baby boomers continue to retire. The increase in the number of sellers will change the balance to a buyer's market, and as a result, there'll be downward pressure on the valuation. And I know probably some of you are wondering, what's the going rate for a firm? and it is about 1 times revenue. And this is if the buyer is paying the agent. It may be 1.1 if the revenue is the seller is paying the commission to the agent. Of course, the amount will be varied based on down payment, length of time the payment is made over, and the time of year. And let me just suggest about a merger. It's a little bit different than an outright sale because the partners probably still want to continue to work. And it has been my personal experience that a merger has been the best option for most sellers. They continue to work, it ensures a smooth transition over to the new firm, and it takes advantage of optimizing business expenses. And how to prepare for this sale. Partners assessing how quickly they can retire need to factor in how frequently they visit with the clients. As I said at the very beginning, more than 85% of accounting firms' clients meet face-to-face with the CPA only once a year. You know it, it's tax season. And if you want a smooth transition, you ideally want to introduce the new buyer to the client. So if you sell the firm in June, the new partner is not going to see that client for 6 to 8 months. Not only that, they're not even going to start to get the revenue until basically February to April. So there's a long time when they're waiting for that period of time, the tax season, to start to increase revenue for themselves. Most CPA firm owners don't go for full-time to retirement in just one step. Consequently, the partner should think in terms of how much time they have left before they want to reduce their time commitment to the firm as opposed to when they want to retire. Here's how you prepare for your sale. Preparing your accounting practice for sale requires careful planning and strategic steps to maximize its value and appeal to potential buyers. Here are a few key actions you can take to ensure a smooth and successful transition. Timing. As previously mentioned, a T1 practice selling in June can expect a reduced price simply because the buyer is not going to see any of the revenue for several months. Financial should be in order, and that goes without saying. Clean financial statements. And obviously, if you're profitable and you have a healthy profit margin, it's going to be way more attractive. I think I'm preaching to the converted here. To have a CRM in place, it gives the buyer a clearer understanding of the type of clients that you have, how frequently you see them, the type of work you do for them, and your relationship with that particular client.
I just want to say a CRM, just in case somebody doesn't know, the client relationship, that management system, like whether you use Salesforce or Maximizer or some other software.
Yeah. Thank you, Ruby. If you're not willing to simply sell based on revenue, you may want to engage a CBV for a costing or a pricing on your firm. And I know that there's a CBV on this call today. You should have your legal documents in place, i.e. your employee contracts, what their salary is, their structure, their peaks, do they have equity, lease documents. And it's really important in a merger, if a new company is anticipating buying you, that you don't take out another long-term lease, that maybe you go on month to month. Your service provider agreements and subscriptions, such as CCH, your professional liability insurance, all of those things the buyer is going to take into account because they want to get economies of scale. And those are the things that make you attractive to the new buyer. Is your technology up to date? I know that there's so much technology that is coming out that it's really hard to keep up. But there are certain things that are out there, whether it's tax templates or other software that you're using that helps you be more efficient. That is going to be very beneficial to the sale of your practice. Your service offerings. I should note that having wealth management as one of your service offerings increases the multiple of the sale simply because of the recurring revenue. And then this is my last tip for you for post-involvement and how long you intend to stay. How do you notify your clients of the transition? Who gets a letter? Who gets a phone call? And may I suggest one thing here? If you're sending out a letter to notify your clients of a transition, I really highly recommend that on the letter, you post that letter in an envelope of the seller's logo on the outside. because the client is going to receive that letter. They're going to anticipate it's something important because you've written to them and you're sending a letter. If it comes from the competitor, they're just going to assume they're being solicited. They'll just throw the letter away. So I just want to encourage you. There's a very good point of making the transition a little more seamless. And with that, those are just a few key things to be prepared your practice or your firm for preparing for a sale or a transition. If you have any questions on this or Ruby's topic, either we'll answer them now or feel free to send them in and we'll do our best to answer them or get an answer for you. Thank you.
There was one question that came in via the chat.
Okay.
Most of the companies that I deal with have no family that want to step in, and the current owner is the key person in the business. Can you give the company to the employees?
I'll address that. There's been some change in, so number one, if you want to gift it, that gets complicated. I'm not a tax specialist, just so you're aware, but with, what their adjusted cost base would be as an example, and about, there could be some adverse tax consequences, but selling it to employees for sure. I was specifically referring to the new employee ownership trust rules, which is an incredible opportunity for succession planning. And just some of my colleagues and some of my former clients are looking at that as a great way, especially very community-oriented people. So huge advantages in the rules. If you just want to, there's a great piece by Grant Thornton, and there was a couple of articles in the Globe and Mail just talking about its effect. But basically 10 million capital gains exemption, double the deferred capital gains time period from just 5 years to deferred capital gains. You've now got 10 years. Most companies that I've been involved in, it's not just one employee that can do it. Usually, especially if it's a larger business, like 20 million or more kind of thing, that it takes a couple of employees. And it also gets key employees working together really well. So that's what I was specifically referring to, the employee ownership trust rules. And, right now it's temporary. I wouldn't be surprised if it does become more permanent. But yeah, so gifting to an employee is a little bit more complicated. The new employee ownership trusts, the employee ownership trust rules are something that I think is really going to change the landscape. It's been my own personal experience and take on this. With selling a practice or exiting a practice. And feel free, Tony, to reach out directly to me or to a tax specialist about that.
And I want to mention one other thing. Has that client, or you've got a couple of clients, have they even asked their employees if they want the business? Because there are a lot of companies that the owner thinks that the employees want it, and it's just not on the horizon for them. So it's probably worth talking to, as Ruby said, reaching out to us, because maybe it's worth talking to someone who's in the business succession planning. You can help the person prepare the business, but there might be some other viable alternatives to them, especially if that person is depending on the business to provide for retirement for them.
Yeah, and I would ask, that's probably one of the biggest questions. And my own personal experience, especially in M&A, is that they're just not prepared, and they may have a financial advisor. And I'm thinking of one case in particular where it was like a $80 million sale, and they truthfully had a relationship with a financial advisor who worked at a big bank, you can imagine. And because most business owners are so loyal to the bank that gave them their first ever loan, that it's just a natural progression. They saw them once or twice a year when the CPA gave them the figures of this is what you should do, X, Y, and Z. And there just was not any proactive planning, no thought about, okay, you're going from a Canadian controlled business in this industry, what's a proper asset allocation from a true big picture point of view, versus just, sticking somebody into, in-house products that are going to be very, very different than owning private businesses in a certain industry, et cetera. So my experience is they just have not been prepared. I don't know how many times business owners said to me, wow, I wish you were still in financial planning, because I would like to talk to you about this. But working with a firm like Wealth Stewards that has a number of CPAs that we know the language, we've been there, we've done that, we've gone through it, both Paul and I many times ourselves, that it's really a valuable tool and a huge differentiator, getting people prepared. Most business owners, their business is their biggest asset, and they are not being well served at all in the general marketplace with good business exiting advice. They're just not getting it. Either they're not getting the questions. That's why I wanted to start with those 10 really important questions, because it's really hard to ask business owners about thinking about exiting their business. Like, I've had clients where the founders in their 80s and 90s and their family just, they have never thought about exiting. Like, you would think by the time they're that age, or the next generation, or they would have had many conversations about this, but it's very challenging. And you have an important role to play, because as CPAs, we're professional, objective, we're trustworthy with these very delicate conversations, and you can do it, and you're perceived as the experts. So, and as I said, when you help people through exiting their businesses too, boy, they just are so relieved, and they're so loyal, and they become raving fans, and then they trust you with, help me find a good financial advisor.
Yeah, I think, Ruby, that you've nailed it. And this is one of those things when you're transferring to your staff, they could be the best production operator, but they don't know really what the financials. So that's a big decision to pass down to the employees. And so we would really love to, walk with you shoulder to shoulder in that, and help you with that with some of your business clients. So thank you for that. Ruby, thank you for sharing today. Thank you for those who participated. And as I mentioned at the very beginning, there will be PD certificates issued. Shelby will be issuing the recordings from all 3 sessions that we've done over the past couple of weeks. And your PD certificates for today will come out by the end of the week. So thank you so much. Appreciate it. And I do want you to keep your eyes peeled, because we will be doing an Outlook 2025 in January. And you can rest assured it's going to be interesting now with this American new president coming in, that there's a lot of different political views of what's going to happen. Maybe you even sat in on the CPA event yesterday with David Frum, but there's definitely going to be some interesting talk on that Outlook 2025. So once again, thank you very much. Thank you, Shelby.
I think it'll affect succession tsunamis too. So thank you for your time, and feel free to reach out. You've got my contact information. I'd be absolutely delighted to talk to any of you. Thank you.